Welcome to Debt Matters, the show where we look at UK financial headlines and regulations to give you practical, actionable knowledge for credit control, for collections management, and of course for keeping your own finances on solid ground.
Today we're analyzing a regulatory adjustment in the payments world. It's a change that, on the surface, looks like a simple upgrade for convenience, but it actually fundamentally alters the behavioral dynamics of spending.
It really does.
No.
And it changes the operational demands on financial services right across the country.
Hmm.
We're focusing on the upcoming change to UK contactless card limits. Specifically, the fact that the statutory cap is being lifted on 19 March 2026.
Yeah, and this isn't just about being able to tap for a bit more money. This is about the regulator handing over the keys to payment security thresholds.
Yeah.
It shifts the whole mechanic of accountability.
So our mission today is really to explore this rule change. We want to connect the dots between the new flexibility it introduces and, well, the real-world fallout.
We'll be breaking down the impact on household budgeting, looking at the potential for rising arrears. I mean, debt can accumulate much faster this way. And we'll also examine the new operational demands this creates for fraud and dispute teams.
So whether you're managing your own household budget or you're setting policy in a major bank, this transition is something that needs careful preparation. It changes the security game from static to dynamic.
It absolutely does.
Okay, so let's start with the regulatory action itself. The date is 19 March 2026. What exactly is happening?
The main action is the removal of the statutory 100-pound contactless limit. Up until now, that cap was set by law. It dictated the maximum you could spend in one go before you had to do a chip and pin verification.
Right.
So the existing legislation that demands that cap, it's just being formally repealed. The financial regulator, the FCA, is essentially stepping back from prescribing a single static limit for these kinds of transactions.
And what does that regulatory step back actually enable? I mean, what kind of freedom are banks and card providers getting here?
It gives them a huge amount of new authority over their own internal contactless thresholds. For the very first time, providers are getting explicit permission to set limits based on their own risk assessment, their technology, and, their competitive appetite.
So the range of choice is pretty vast then.
It is. They could choose to raise the limit just a little, say to 150 pounds. They could redesign the system completely, maybe with dynamic limits that change based on your personal spending history. Or, in theory, they could remove the cap altogether if they can prove their fraud detection systems are robust enough to handle that risk.
That sounds like a fundamental shift. We're going from a uniform, government-mandated baseline to a competitive, provider-specific risk calculation.
That's it, exactly.
But if we're removing the per-transaction cap, does this also apply to the other security measure we have, the cumulative spending rule?
Yes, and that's a key detail that often gets missed in the headlines. The same flexibility applies to that cumulative rule, which is, right now, a really critical line of defense.
Remind us how that one works again.
Currently, that rule demands a chip and pin check after you spent a total of 300 pounds through contactless or after 5 consecutive taps, whichever comes first.
Right.
That pattern of mandatory checks, which resets the card's security counter, that is also now subject to the provider's discretion under these new rules.
So a provider could decide to raise the cumulative limit from 300 to 500 pounds, or maybe allow 10 taps instead of 5 before a pin is required.
Precisely. They can adjust both the monetary threshold and the tap count as long as they can justify the security of it to the regulator. And this is where it gets really complex for the back office fraud teams, because instead of managing one standard rule, they might have to manage an almost infinite variety of customized risk profiles.
But this is the crucial point we have to keep coming back to. This is an authorization, not an obligation. The UK isn't just switching to unlimited tapping overnight.
That is the most important point for understanding the rollout period. The providers will decide what to do next. And these decisions are costly. They involve system upgrades, retraining staff, risk modeling.
So it's likely a lot of them will just stick with the current limits, at least at first.
I think that's highly probable. Many banks and payment companies will probably maintain their existing limits initially. Maybe they'll run some pilots or do some A/B testing with certain customer groups. They'll be waiting to see what their competitors do, or until they're absolutely certain their fraud controls are stress tested.
So the immediate impact on March 19th, 2026 might actually be quite small for most of us, but the real importance is in the future, potential it unlocks.
Exactly. The real importance is the long-term trend. It opens the door for steadily higher limits over the next few years, depending on, technology advancements and authentication like better biometrics, and commercial pressures forcing banks to offer more convenience to keep customers.
So it changes the industry's entire question from, are we allowed to raise the limit, to when is the best time, risk-wise, to raise the limit?
You've got it. That's the new landscape.
And even today, we rely on existing mechanisms that prevent just endless tap and go. Can you just quickly reiterate how that current pattern of security checks works? The one providers can now refine.
Yeah, of course. The existing pattern is critical context. Under the current rules, that mandatory PI and check requirement resets once you complete a chip and PIN transaction.
So like getting cash from an ATM or paying for fuel at the pump.
Exactly. Or even just entering your PIN at a supermarket checkout for a big shop. That action proves you have the physical card and you know the PN, and that's what stops a lost card from being used forever. Under the new rules, providers can alter the frequency and the trigger for that mandatory check. They might reset the counter after a verified mobile wallet payment, for example, or after a specific biometric check in their banking app rather than relying only on a physical chip and PIN.
So the infrastructure for verification is still there, but the sequence is shifting from a uniform rule to a bespoke commercial strategy.
That's a great way to put it. It sounds like the industry is being asked to swap a simple speed bump, the 100-pound cap, for a much more complex, sensor-driven risk management system.
Which requires a lot of investment in tech and compliance over the next couple of years.
Substantial amount, yes.
So let's look at the motivations behind this. Why is the FCA doing this now? Why move away from the safety of a fixed statutory cap?
The regulator really sees this as essential modernization. It's driven by two key realities. First, the payment landscape has just fundamentally changed.
Contactless isn't a novelty anymore.
Not at all. For many, it's the standard, the default in-store payment method for daily spending. The old rules were based on a world where contactless was just a nice-to-have extra. The new rules have to reflect its primary position in the market.
And then there's the unavoidable reality of prices going up, which has effectively made the 100-pound cap feel, well, a bit outdated for a lot of transactions.
It absolutely does. It's an issue of economic utility. When the cap was set at 100 pounds, that amount bought a lot more. With inflation, rising costs across the board, the practical purchasing power of that 100 pounds has really diminished.
Yeah, you see it all the time. The weekly grocery shop for a family can easily go over 100 pounds now.
Exactly. So if your average shop is now 110 pounds or 120 pounds, having to revert to chip and PIN every week kind of cancels out the main benefit of speed that contactless was designed for. It just creates a bottleneck.
It becomes a source of frustration, undermining the tech.
It does. If the goal is seamless commerce, a cap that's constantly being hit by standard, everyday transactions just defeats the purpose.
We also have to acknowledge that technology itself has already kind of moved beyond the security limitations the regulator had imposed. I'm thinking specifically about mobile wallets.
This is probably the strongest argument the regulator could make. Mobile wallets, paying with your phone or your watch, they already have robust high-security authentication that's far superior to the physical card itself. But the statutory cap was stopping these secure methods from being used for higher-value payments.
Because they use things like biometrics Face ID or fingerprint scanning, which are often seen as much stronger proof of identity than just a 4-digit PIN you type in public.
Precisely. Mobile wallets use device-specific tokenization, which means your card details are never actually stored or transmitted in the transaction. Plus, that mandatory device security provides a level of strong customer authentication, or SCA, that often exceeds what's required for even a traditional chip and PIN.
So the old cap was actually holding back better security.
It was actively hindering it, yes.
Right.
Removing the cap just allows the payment ecosystem to leverage the authentication tech that's already in the user's hand.
So the regulator is basically saying, the tech is secure enough, the market can now decide the appropriate limit. But they haven't removed all oversight, have they? This whole shift is guided by a sort of triple goal.
That's right. The FCA has been really clear that this is all contingent on providers sticking to three principles. First, flexibility allowing innovation and responsiveness. Second, maintaining strong fraud controls. The expectation is still that providers must design systems that ensure higher limits don't lead to unacceptable levels of fraud.
They've got to prove their risk modeling is sound.
Absolutely. And the third principle, which is critical for all of us, is preserving customer choice.
And that's the foundation of accountability in this new world.
It is. It means making sure that customers have comprehensive control over how they pay and, crucially, what personal limits are on their cards and accounts. The focus is on demonstrating that convenience doesn't just override personal security or financial management tools. The regulator expects banks to actively promote and make these tools accessible.
So it sets up a competitive environment where banks have to balance offering the highest possible limit for convenience against offering the most robust, customizable security controls to reassure their customers.
That's the premise, yes. The move forces competition on the quality of security and customer empowerment rather than just competing to stick to a mandated floor.
Okay, this is where the conversation turns to human behavior and financial well-being. Let's unpack this concept of friction in payment systems, because getting rid of it has profound and often unrecognized consequences.
When we talk about friction, we're describing the cognitive and physical effort required to complete a transaction. It's that momentary effort, reaching for a card, putting it in the machine, typing those 4 digits. This isn't just about speed. It forces a brief, conscious engagement with the act of spending money.
Yeah, and most of us just think of friction as a pain, though. You get a new fast tap card and you celebrate the convenience. But you're suggesting this very friction serves as an accidental but vital budgeting tool.
It absolutely does. It acts as a mandatory moment to pause, a cognitive speed bump. The act of entering a PIN in for a 120-pound purchase forces your brain to register that a threshold has been crossed. It makes you do a brief, conscious assessment against your budget. It makes the transaction feel tangible, accountable, in real time.
So if these contactless limits rise significantly or even disappear for mobile payments, we lose that automatic check. The payment shifts from a deliberate action to just a passive confirmation.
And the real risk isn't that people are suddenly going to start impulsively tapping 500 pounds for a new TV. The risk is much more subtle, it's cumulative, and it's rooted in, well, established behavioral finance concepts. When the limit rises, it allows smaller, discretionary purchases to just stack up without any kind of cognitive barrier.
Can you connect that loss of friction to some of the specific cognitive biases that affect our budgeting?
We can connect it directly to two major biases. The first is mental accounting. We tend to categorize money differently depending on where it sits. Cash feels real or scarce. But money on a fast, frictionless credit card tap often gets put into a less accountable, sort of flexible mental budget, which makes it much easier to spend.
So removing the PIN barrier just reinforces that feeling of easy money.
It does. It weakens the emotional attachment to the spending in that moment. The second major bias is the planning fallacy, or just simple lack of impulse control. If I plan to limit my impulse, buys, coffees, lunches to, say, 50 pounds a week, the moment I have to enter my PIN, I'm forced to confront whether I'm sticking to my plan.
But with high limit or unlimited tapping, that plan just erodes, unnoticed, tap by tap.
Exactly. The ease ensures that those mid-value discretionary taps add up far more quickly than you estimate. If the limit moves to, say, 500 pounds, that's not really permission to tap for 500 pounds. It's permission to tap 120 pounds 5 times without any consequence or reflection.
And that's the true danger for debt accumulation.
It is. The payment process moves from an active, deliberate model to a passive, almost subconscious one. And that's especially true for those who already struggle with managing revolving credit.
So let's really focus on that credit card link. For people who rely on revolving credit to manage their cash flow, how does the speed of payment directly translate into a higher risk of arrears?
The implications are very direct. When the process is frictionless, your outstanding balances just accumulate faster. This can lead to your credit utilization rate shooting up, sometimes pushing you into a higher risk category without you even realizing it.
And that rapid accumulation, which feels painless at the time.
It increases the disconnect between the spending action and the monthly statement. You get a bill at the end of the month that is substantially higher than your internal mental estimate because you never had that moment of reflection when you were spending.
So you realize too late that the spending felt easy because the security layer was removed, not because the money was plentiful.
And that shock, that directly increases the likelihood of financial distress. We then see people trying to make only the minimum payment, or worse, missing the payment entirely because of a cash flow crunch caused by that unanticipated high debt. That is the direct path from payment convenience to rising arrears.
So the more frictionless the spending becomes, the more the responsibility for discipline shifts entirely onto the user's active monitoring.
It does, and that reliance on self-control is what credit professionals have to prepare for when they're having collections conversations after 2026. The reasons given for debt will increasingly focus on the ease of payment, not just a sudden change in circumstances.
The narrative of, I just didn't realize how quickly it all added up, is going to become more and more common.
I think that's highly likely, and collections agents will need training to navigate that behavioral explanation while still, emphasizing financial accountability and the self-control tools that are available.
Okay, let's pivot now from consumer psychology to the back office reality. For credit teams, for collections agencies, for lenders, this regulatory relaxation introduces a new level of risk. What's the main operational impact we should expect to see?
The central issue is a likely increase in both the value and the volume of transaction disputes. That includes legitimate fraud, but also what the industry calls friendly fraud, which is often a customer claiming they don't recognize charges simply because they weren't tracking them in real time.
Let's focus on genuine fraud first. If a provider raises the limit to, say, £350, what happens when a card is lost or stolen?
The potential value of fraudulent spending per compromised card just goes up dramatically. Fraudsters can engage in what's called velocity fraud tapping very quickly, knowing they have a much higher ceiling and a longer cumulative runway before the system demands a PIN or the owner realizes the card is gone.
So a criminal can rack up a much higher balance of unauthorized spending in that crucial first hour before the card is frozen.
Exactly. And that higher fraud value per incident directly impacts the lender's immediate financial loss and their capital requirements.
And beyond the direct financial loss, how does this higher volume and value of unauthorized transactions affect the back office admin and collections?
It creates an administrative cascade that affects every part of the operation. A higher volume of these transactions means three immediate challenges. First, more chargebacks requested by customers, which kicks off complex, resource-intensive investigations.
Sure.
Second, a surge in general customer complaints and inquiries about unrecognized transactions, which puts a strain on contact centers. And the third challenge, which is critical for collections, is customers strategically pausing payments.
Right.
The increased anxiety around fraud, combined with the higher value of disputed items, means more customers will temporarily pause their scheduled debt payments while an investigation is underway. This pausing introduces cash flow volatility, it complicates arrears projections, and it just increases the admin work needed to manage an account flagged as in dispute.
That brings us to the operational need for better evidence collection. When disputed transactions involve larger, easy, contactless taps, the pressure on lenders to resolve them quickly and accurately is going to increase. What kind of technical evidence will teams need to get a better grip on?
They need to move beyond a simple statement line items. They'll need granular, easily accessible data linked immediately to the payment. Specifically, teams are going to require, first, highly accurate timestamps and maybe even geolocation data.
So not just the minute of the transaction, but verifiable data that can place the terminal, which can then establish a pattern of legitimate activity.
Precisely. Second, detailed merchant information. Beyond just the name on the statement, systems need access to the merchant's business category and their terminal ID. This helps spot patterns where lost cards are being used for high-value, easily resellable goods.
And third,
Cross-referenced authentication. Lenders have to be able to quickly verify how a transaction was authenticated. Was it a physical card tap, a mobile wallet with biometrics? This requires much tighter integration between fraud monitoring software and the customer's payment profile.
so it's about building a digital trail that's robust enough to withstand scrutiny, especially if a customer is claiming the loss was the bank's fault for having such a high limit.
Exactly. And in a collections context, there's a fourth crucial piece of evidence: comprehensive vulnerability and communication notes. If a customer in arrears suddenly disputes a £200 transaction, the agent must meticulously record all claims. Was the card stolen? When was it reported? Did they claim financial vulnerability at the time? That level of detail is necessary not just for fraud resolution, but for maintaining compliance.
The burden of proof is definitely rising then.
It is.
Let's also touch on the perception effect you mentioned. Even if banks don't raise limits straight away, the headlines announcing the possibility of higher limits could still cause operational strain.
Absolutely. The perception of increased risk changes customer behavior. When people know high-value fraud can happen easily via contactless, they become more suspicious of any unrecognized transaction on their statement, even small ones. This leads to an uptick in that friendly fraud customers who, maybe due to poor record-keeping, challenge transactions they actually made.
So lenders will need to increase proactive customer education to manage these perception-driven disputes, which consume just as many resources as genuine fraud investigations.
They will. In essence, credit professionals have to plan for a world where every single contactless transaction, regardless of its value, comes with a higher implicit risk profile and a greater need for immediate verifiable data linkage.
This analysis clearly shows that preparation is key, both for individuals and for professionals. Let's start with practical actions consumers can take right now to reclaim some control in a world that's being designed for convenience.
This is all about intentionally reintroducing the cognitive checks that the system is removing and using the available technology to protect yourself.
The first, and I'd argue most essential step, is turning on instant spending alerts.
Real-time monitoring is absolutely non-negotiable in a high-limit environment. If a card is lost or stolen, an instant push notification lets you identify and freeze that card within seconds. It minimizes potential losses far more effectively than waiting for your monthly bill. It's your first line of defense.
Secondly, consumers should be proactively looking for and setting custom limits in their banking apps, rather than just accepting the new default.
This is you, the consumer, taking advantage of that customer choice principle. Don't wait for your bank to raise the default to £300. If your bank offers the feature, and you should actively check if they do, proactively set your own contactless cap, maybe keep it at £100, or even lower it to £50 if you know you're prone to impulse spending. It's a powerful way to self-impose the friction the regulator has removed.
And for individuals who know that easy access to credit is a significant personal risk, there's a more drastic but very effective preventative measure.
Strategic deactivation. It's a vital self-management tool. If overspending is a known risk, particularly on a credit card, consider turning the contactless feature off entirely. If you're forced to insert the card and enter a PIN in for every single transaction, you intentionally build that friction back into the system. You guarantee a moment of reflection every time you spend.
And the final, crucial consumer step is about immediate action if a card goes missing. Speed is everything.
Absolutely. The single most effective tool you have is the ability to instantly freeze or lock your card using your bank's mobile app. It has to be done the second you realize the card is missing. The same technology that allows for higher contactless limits, your smartphone is also your best tool for mitigating the risk those higher limits create.
Okay, now let's shift focus to the institutions. What specific actions must lenders and collections agencies be taking to prepare for this 2026 shift?
The preparation involves massive investment in three areas: training, technology, and what I'd call compliance signposting. First, script updates and agent training. Collections agents need immediate training on the new rules and the potential for customers to use this change as a way to dispute debt.
So collection scripts and FAQs have to be updated specifically for handling these unauthorized transaction queries.
They do. The language has to be standardized, non-confrontational, and geared towards getting the specific evidence needed to resolve the dispute efficiently. This includes training agents to quickly find out if a customer has used the available self-control tools, because that can affect the bank's internal liability.
So you're not just training them on rules, but on customer behavior, recognizing that some disputes might stem from poor self-control, not actual fraud.
Exactly. Second is operational planning and system upgrades. This is paramount. Institutions have to develop detailed strategies and allocate resources for a potential uptick in dispute volume, especially in the 12 to 18 months after March 2026. This means a big investment in fraud monitoring systems that can instantly cross-reference and retrieve that data we talk about: geolocation, merchant ID, authentication method.
Because if you can't get that data quickly, you might be forced to swallow a chargeback loss you could have otherwise refuted.
That's the real operational threat. And finally, there's the critical element of customer control signposting and compliance. Providers have to show they're actively meeting the regulator's expectation of preserving customer choice. This means ensuring those control options, like custom limits and one-tap card freeze buttons, are not buried in confusing menus.
So if a bank raises its default limit, the communication about how a customer can lower that limit has to be impossible to miss.
It has to be crystal clear. The overall preparation involves moving security from a passive mandate, the £100 cap, to an active partnership between the bank's detection systems and the consumer's own self-management tools.
That sums it up really well. The era of regulatory security mandates is ending. and it's being replaced by an era of individualized algorithmic risk management, which requires vigilance from everyone involved.
It really does.
So we have thoroughly examined this transition. Let's just reiterate the essential summary. The key takeaway here is that the end of the statutory 100-pound cap on 19 March 2026 is less about immediate unlimited spending and much more about opening the regulatory door for providers to raise limits over time.
This shift fundamentally changes the security conversation. It moves it from a regulatory threshold to a commercial risk decision. And that puts an unprecedented focus on sophisticated fraud prevention mechanisms built into bank systems and, vitally, on the self-service control options available to the customer.
The call to action is undeniable. If you work in credit control or collections, this requires monitoring, script updates, and proactive operational preparation for the increased value and complexity of disputes.
And if you're managing your own money, understanding and actively using these self-service control options, setting alerts, custom limits, or deactivating the feature is absolutely essential to maintaining command over your household budget in a payments world designed for maximum low-friction convenience.
So we'll leave you with this question to think about. This whole push for payment flexibility relies heavily on the consumer's willingness to exercise self-control and actively engage with their security settings. As banks use their new permission to raise limits for competitive advantage, how much responsibility will they place on you, the individual, to actively seek out and set safe, personalized limits? And critically, how much will consumers actually value that essential pause, the necessary friction, when faced with the temptation and speed of an increasingly frictionless tap? That interplay between convenience and financial accountability is what's going to define household budgeting in the post-2026 era.
Thank you for joining us for this examination of Debt Matters.